Welcome back to Chapter 9 in your Cornerstones textbook. We're going to deal now with discount and premium bonds and how we account for the amortization of the discount or the premium while the company is paying interest. We're going to focus on the piece of your chapter that uses the straight line method for discount and premium bonds. We will not focus on the effective interest rate method. So what if the bonds were issued at a discount, meaning that the selling price the company received on the day that it issued the bonds was less than the face value or the par value? Remember from Cornerstone 9.1 that resulted in an entry to an account called discount on bonds or discount on bonds payable. So we have to amortize that discount, or essentially expense it out every single year. So remember that interest payment is always the principal times the coupon interest rate times the portion of the year that the coupon payment covers. The discount amortization will be the total discount amount divided by the number of interest payments for that bond. So if the bond is a 5-year bond that pays annual interest, it'll be 5 interest periods. If it's a 5-year bond that pays interest semi-annually, meaning twice a year, there would be 10 interest periods. And then that is how we get to the interest expense for every single year. The interest expense will be the total of interest payment plus discount amortization. So when you have a discount bond, you can't just assume that the interest payment is equal to the interest expense. It won't be. The interest payment, what actually is paid to the bondholders, is found by this formula here, but we have to add the discount amortization to find out what the interest expense that's booked on the company's books will actually be. So let's look at an example. We've got Leela Inc. They issue a 5-year, $100 million bond at 8% coupon, and they issue it at 99, meaning 99% of the face value. That comes to $99 million instead of $100 million. The discount at the time of sale, of course, is the $1 million, and interest is paid semi-annually on June 30th and December 31st. So first, let's prepare the journal entry to record the issuance of the bonds on December 31st. So remember, we're now going to record a discount bond. So we received cash of how much? Right, they only received cash of $99 million. So there's a debit to cash of $99 million. And then we are going to have a debit to the account called discount on bonds payable. And that's going to be the value of the discount, which is the $1 million. And then we actually have a credit to the liability account bonds payable to the tune of the full face value, so $100 million. That's how we record a discount bond. Now, what amount of discount will be amortized every time interest is paid? Interest is paid, remember, semi-annually, meaning every 6 months, 2 times a year. So we said that the formula for a discount amortization is to take the total amount of the discount and divide it by the number of interest periods. How many interest periods will there be in a 5-year bond that pays interest semi-annually? Correct. There will be 10 periods of interest payment, and there is a $1 million discount, which we already know. So the amount of discount that's amortized every interest payment period will be $100,000 per period, or $200,000 per year. So what will be the amount of the interest expense for each semi-annual period? Well, first we need to know what is the interest payment, and then we will take the interest payment for each interest period and we will add the discount amortization that we just found up here, which is $100,000 per period. How do we calculate the interest payment? Well, remember, that's always the face value times the coupon rate, or the coupon interest rate, times the amount or the portion of the year that each interest payment covers. So it's $100 million of face value or par value. There's an 8% coupon rate, and each interest period is 6 months. So 6 divided by 12, we come up with that each interest payment, the amount of money that is paid to bondholders every 6 months, is $4 million. Plus, I add to the fact that $100,000 of discount amortization is occurring every time the interest is paid. So the interest expense for every semi-annual interest period is $4,100,000. Now, here's what we do. For bonds that are either discount or premium, we build a thing called an amortization table. And what we try to figure out is, over the life of the bond, we move from the amount of cash that the company actually received, and we know that eventually on the last day of the bond at maturity, the value of that bond must rise from the amount actually received at issuance to whatever the par value was. Par value is $100,000, so we know the carrying value, or the amount of the bond, eventually has to be on the books the value of par, which is $100 million. So we would fill out an amortization table, and it would have these columns on it. The cash interest payment that is made every semi-annual period. Then we would enter what is the actual expense that is booked on the company's books. What portion of the discount is amortized for that period, and then what is the balance at the end of that period? What is the balance on that bonds payable discount? So at issue, we know that the value of the total discount was $1 million, because at the issuance date on December 31st, 2011, the value of the discount was $1 million and the amount received was $99 million. In the first interest payment period, which would have been on June 30th, 2012, there would have been, remember we had already figured out, it's $100 million times 8% times 6 divided by 12 gave us $4 million of interest payment made to bondholders every 6 months. Plus there's another $100,000 of discount amortization that occurs each time. So that means that the total interest expense is $4,100,000. This is the $100,000 of discount amortization. So that means I now amortize the discount down by $100,000. I'll reduce the discount on bonds payable by $100,000, which means I have $900,000 of bonds payable discount left. The carrying value then on this bond just went up by $100,000. If the discount went down by $100,000, then the carrying value went up by $100,000. And this is how we would actually fill in each year. Every single interest payment period, if you notice, is always going to be $100 million times 8% coupon interest times 6 divided by 12 months. It's always going to be $4 million. And I'm always going to have $100,000 of discount amortization every single interest period, because we are using a straight line method, so it should be the same interest payment and discount amortization per period, which means my interest expense that I book as a debit for every single 6-month interest payment period will always be the sum of $4 million plus $100,000. Every time I book a credit to discount on bonds payable for $100,000, the balance on my bonds payable discount will decrease by $100,000 until eventually I have amortized the entire discount down to zero. While I am doing that, the amount of my carrying value, the total liability on my book, keeps increasing until finally I hit maturity on December 31st, 2016, and I am paying back my bondholders the full $100 million face value. So what will the journal entries look like to recognize interest expense every June 30th and December 31st between 2012 and 2016? Well, it's always going to have a debit to interest expense of the $4,100,000. There will always be a credit to cash of the interest payment. Remember, we don't pay the bondholders the discount amortization. We just pay them the coupon payment of $4 million, which means I then also have to be amortizing my discount. And the way I do that is not by entering an expense to amortization. What I do is I debit the discount on bonds payable account by $100,000 every time I make an interest payment. So I've got my total expense of $4,100,000. Only $4 million of that went out in cash to the bondholders. The other $100,000 of that was a reduction in the total discount on bonds payable. So let's look at the entry. What entry would I make at the end of this bond? Well, I would make an entry on December 31st, 2016 by clearing my bonds payable, and the way I clear a liability account is by making a debit entry. I'm going to make it for the full $100,000 par value of this bond, and I'm going to have cash go out the door in the exact same amount. This concludes the second video for Chapter 9.